Let me ask you a simple question. What happens when a bank runs out of money, not in the long run, but right now? This isn't some rare end-of-the-world scenario. It's something every bank needs to think about every single day. Because when customers want to withdraw cash, move money, or pay bills, the bank has to be ready. It needs that money available on the spot. No delays, no excuses. And that's where liquidity management comes into play. In this video, we're going to explore what liquidity means in the world of banking, how banks make sure they always have enough of it, why this matters so much for the entire financial system, and how all of this quietly impacts your life, even if you've never thought about it before. So what does liquidity actually mean in banking? Well, let's begin with the big question, what exactly is liquidity? Well, at its core, liquidity is all about how quickly something can be turned into cash. The more liquid an asset is, the easier it is to spend or use to pay someone. For example, physical cash is the most liquid asset you can have. It's ready to use immediately. Money sitting in your bank account is also highly liquid because you can access it instantly via card, app, or ATM. But something like a house or a car, not so much. Those are considered illiquid because you need time to sell them and convert that value into cash. Now let's apply this to a bank. When we talk about liquidity in banking, we're referring to a bank's ability to meet its short-term financial obligations. So that means paying out money when customers want to make withdrawals, send payments, or transfer funds. Even if a bank is profitable overall or owns lots of valuable assets, it could still be in trouble if it can't come up with enough money right now to meet its daily needs. So in banking, liquidity isn't just about wealth, it's about availability. It's about having enough money ready to go at any moment to keep things moving smoothly. So why is liquidity so important for banks? Well, to understand why liquidity matters so much, let's imagine a situation that could happen to any of us. You open your banking app and decide to transfer £5,000 to a family member. It's a routine transaction. Now imagine thousands of customers all doing something very similar at the same time. Maybe because they heard a rumour that the bank is in trouble, or because there's breaking news that triggers a panic. Suddenly, the bank needs to come up with millions of pounds in cash immediately. If it doesn't have that cash available, it doesn't matter how profitable it was last year or how many long-term investments it holds. If it can't make payments on time, it's facing a potential collapse. This is what we mean when we say that a bank can be solvent but illiquid. It's like owning a beautiful home worth £1 million but not having enough in your current account to pay your electricity bill. You're not broke, but you've got a serious cash flow problem. That's why liquidity management is so important. It's the process that ensures banks can always meet their financial obligations, especially in moments of high stress or unexpected demand. So how do banks manage their liquidity on a daily basis? Well, managing liquidity might sound like a dry technical task, but in reality, it's one of the most dynamic and high-stakes parts of running a bank. The process begins with forecasting. Every bank monitors its expected inflows and outflows of cash. That means keeping track of how much money it expects to receive, such as loan repayments or incoming deposits, and how much it expects to pay out, whether that's customer withdrawals, loan funding, or interest payments. It's a bit like running a household budget, only with billions of pounds moving in and out every day. To stay ahead of unexpected events, banks also maintain something called a liquidity buffer. Now, this is essentially a pool of assets that can be sold quickly to raise cash if needed. These assets are usually very safe and easy to convert, like government bonds or cash deposits at the central bank. So think of it like an emergency fund. The bank doesn't touch it unless it absolutely has to, but it's there as a safety net. Banks also pay close attention to where their money comes from. They don't just rely on one source of funding. Instead, they try to diversify. Some of their funding comes from regular customer deposits, people like you and me. Some comes from borrowing on wholesale markets. Some may come from central banks. If a bank relies too heavily on one source, say a few large corporate clients, then it's vulnerable. If those clients pull their money out suddenly, the bank could be left scrambling. So liquidity managers build resilience by mixing funding sources and keeping backup options open. Another key part of liquidity management is stress testing. Banks regularly simulate worst-case scenarios to see how their liquidity would hold up. For instance, they might model what would happen if 20% of customers withdrew their money in one day, or if global markets froze and they couldn't sell assets quickly. These tests help banks plan ahead, adjust their buffers, and prepare for shocks long before they happen. So what can happen when liquidity management fails? Well, to understand how crucial liquidity really is, let's look at some real-world examples, one where it's failed and one where it's succeeded. Back in 2007, a UK bank called Northern Rock became the first high-profile victim of a liquidity crisis during the global financial meltdown. Northern Rock was heavily reliant on borrowing from other banks and markets. But when confidence collapsed, those sources dried up almost overnight. The bank couldn't raise enough cash to keep going. Customers panicked and started queuing outside branches to withdraw their money. It was the UK's first bank run in over a century, and all because the bank didn't have the liquidity to meet demand in a crisis. Fast forward to 2020, during the COVID-19 pandemic, financial markets went into shock. But this time, most banks weathered the storm. Why? Because after the 2008 crisis, regulators introduced strict liquidity rules like the Liquidity Coverage Ratio, which requires banks to hold enough liquid assets to survive 30 days of extreme stress. Banks were also better at forecasting, stress testing, and diversifying their funding. As a result, even in a time of global panic, the system held together. Now at this point, you might be wondering, if you're not a banker, why does any of this matter to you? Well, here's why. If your bank manages its liquidity well, your money is safer. Your savings, your paycheck, your mortgage payments, they all depend on the bank's ability to function reliably every day. You might never think about it, but when you tap your card at the supermarket or pay a bill through your app, liquidity is what makes that transaction go through. Good liquidity management also means fewer disruptions in the broader financial system. It keeps interest rates stable, ensures loans are available, and maintains confidence during economic shocks. Without it, small problems can spiral into full-blown crises. In short, liquidity is like the oxygen of the banking system. You don't notice it when it's there, but if it runs out, everything starts to collapse very quickly. So here's the key takeaway. Liquidity management might not be flashy, but it's one of the most important things happening behind the scenes in banking. It's what ensures your money is where it needs to be when you need it. It keeps the system moving, even under pressure. So next time you transfer money, tap your phone to pay for lunch, or get paid on payday, think about the careful planning that goes into making that process feel instant and effortless. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.